If you own a home in Canada and you are 65 or older, listen carefully before you do anything else in 2026. The Canada Revenue Agency has rolled out major changes to how property is taxed, how it is reported, and how provincial property tax deferral programs work. Every one of these changes can hit a senior's retirement savings directly. I am talking about real money. Thousands of dollars, possibly tens of thousands of dollars, that could quietly drain your nest egg this year if you do not know the rules. This is not a rumor. This is what is in effect for the 2026 tax year right now. Pay close attention to every word. Here is why this matters right now. In 2026, Canadian seniors are facing the strongest wave of property-related tax enforcement we have seen in years. Some of these changes came through provincial property tax deferral programs, especially in British Columbia. Others come from existing CRA rules that the agency is now applying more strictly than ever before. Many of you built your homes with your own hands. You paid off your mortgages. You raised your families in those homes. You always believed the family home would be the one thing the government could not touch. In 2026, that assumption can cost you. The Canada Revenue Agency now requires specific paperwork when you sell any residential property. The agency audits seniors more aggressively than it used to. Provincial deferral programs that once helped seniors stretch their property tax payments are now charging much higher interest. And the rules around cottages, second homes, family transfers, and inherited property have all been tightened behind closed doors. If you do not know these rules, you could lose $5,000, $10,000, or even $20,000 from your retirement savings without any warning letter at all. Let me walk you through the 5 things every Canadian senior needs to know right now. If you live in British Columbia, this is the biggest alarm bell of 2026. The BC Property Tax Deferment Program helps eligible seniors delay paying municipal property taxes until they sell their home. For decades, the program was a lifesaver for retirees on fixed incomes. Thousands of BC seniors used it every single year. The interest rate sat at prime minus 2%, which made it one of the cheapest borrowing options in the country. That changes completely on January 1st, 2026. The new rate is prime plus 2%, and the interest now compounds. Let me say that again. It now compounds. Before 2026, interest was simple and was charged below prime. Now, you pay interest on top of previously accumulated interest every year. That is up to a 4 percentage point jump compared to the old program, and the math compounds against you from day one. Let me make that real with a typical example. Imagine Margaret, a 72-year-old widow in Surrey, BC. She deferred $4,000 in property taxes in 2024, then another $4,200 in 2025. Under the old rules, her effective borrowing rate was very low, and the interest never snowballed. Under the new 2026 rules, with prime around 5%, her borrowing rate is about 7%. And that interest compounds annually. By the time she eventually sells her home in 10 years, she could owe the province $15,000 or more instead of the $8,000 she would have owed under the old rules. That is real money disappearing from her estate. The BC Seniors Advocate has publicly warned about this change. Eligible seniors still have a chance to opt out of new deferrals before higher rates lock in, but if you stay enrolled in fresh deferrals from 2026 onward, the new math is brutal. British Columbia is not the only province watching this pattern. Alberta runs its own seniors property tax deferral program. Ontario has a property tax postponement program for low-income seniors. The specific rules vary, but the direction is clear. Provincial programs are getting more expensive for seniors who rely on them, and that is squeezing nest eggs from coast to coast. This trap catches thousands of Canadian seniors every single year, and it is almost entirely preventable. Let me explain. When you sell a home that has been your principal residence, meaning your main home, you normally do not owe any capital gains tax. That is what we call the Principal Residence Exemption, or PRE. It is one of the most valuable tax breaks in Canada. For many families, it has shielded hundreds of thousands of dollars in home value appreciation from the Canada Revenue Agency. But the CRA has one rule that most seniors do not know about. To claim the exemption, you must file a specific form. It is called Form T2091, or the designation of a property as a principal residence by an individual. You must file this form in the tax year you sold the property. Even if your home has been your only residence for 50 years, you still must file the form. There is no automatic protection. Let us walk through another example. Imagine Robert, a 68-year-old retiree in Mississauga, Ontario. He sold his family home in 2025 for $980,000. He never filed Form T2091 because he assumed the gain was automatically exempt. 2 years later, the CRA reassessed him. Because he did not designate the property in writing on the form, the CRA denied his exemption for the years he failed to designate. Robert owed $8,000 in tax plus interest. He was devastated. He thought he had paid his dues a long time ago. The CRA treats every year you fail to designate as a separate offense. The minimum penalty is $100 per month per property, with a typical minimum around $1,000. The maximum penalty per year is $8,000, and these penalties sit on top of any actual tax you owe. So if you owe tax because you did not designate, you also owe the penalties. They do not replace each other. If you sold any residential property in the last 4 years and did not file Form T2091, consider filing an amendment as soon as possible. The CRA has been offering relief through the Voluntary Disclosures Program, but that window is not guaranteed to stay open forever. For more than a year, Canadian seniors have been hearing scary news about a change to the capital gains inclusion rate. The federal government originally announced that the rate would jump from 50% to 67% on June 25th, 2024. It was then deferred to January 1st, 2026. Many financial advisors told their senior clients to sell investment properties before the deadline to lock in the lower rate. Some seniors rushed to sell cottages and rental homes in panic. Here is the real story for 2026, and it is actually good news. On January 31st, 2025, the federal government formally canceled the proposed increase to the capital gains inclusion rate. The change is no longer happening. The 50% inclusion rate remains in effect for 2026 and beyond. There is no urgent deadline to sell a property simply to avoid an imminent federal tax increase. But this is where many seniors still make a costly mistake. They confuse the canceled federal change with separate provincial and property-specific rules that are very much alive. For example, BC has its own BC home flipping tax, and the program was updated in 2026 with new terminology around the words acquire and dispose. If you sold a BC property in 2025 or earlier, the BC home flipping tax still applies based on the holding period and the profit. The other confusion comes from cottages and vacation properties. Many seniors in places like Muskoka in Ontario, the Laurentians in Quebec, or the Okanagan in BC own a second property. If you sell that property, even if you have used it personally for years, the principal residence exemption only applies to one property per family per year. You cannot designate both your city home and your cottage as your principal residence for the same tax year. This rule catches retirees off guard all the time. They assume the cottage exemption is automatic. It is not. If you are considering selling a second property in 2026, get professional advice on which specific years to designate as your principal residence. The difference between a smart designation and a missed designation can be tens of thousands of dollars in taxes owed or saved. Here is some genuinely good news for 2026. The federal underused housing tax, known as the UHT, has been eliminated for most Canadian owners. The UHT was a 1% annual tax on the ownership of vacant or underused residential property in Canada. It took effect in 2022 and applied to many Canadians, even though it was designed to target non-resident owners. Most Canadian owners were technically exempt, but they still had to file Form UHT-2900 every year, with penalties that could reach $5,000 for a missed deadline. The federal budget passed on November 17, 2025, announced that the UHT would be eliminated for the 2025 calendar year and beyond. For 2026, you no longer need to file UHT-2900 if you are a Canadian citizen, permanent resident, or Canadian corporation owning residential property in your own name. That is a huge relief for thousands of seniors who dreaded the annual filing. But you still need to clean up any old filings if your situation is more complex. If you owned property as part of a partnership, a trust, or jointly with non-resident family members, your situation may be different. Some categories of owners are still required to file. Let us use one more example. Imagine Wei, a 71-year-old in Vancouver, BC. He and his adult daughter, who is a U.S. citizen, jointly own a small rental property. Wei thought the federal UHT cancellation meant everything was resolved for him. But because his daughter is a non-resident owner, they still need to look closely at provincial vacant home taxes, BC's speculation and vacancy tax, and any remaining CRA obligations. The rules did not disappear entirely for his situation. If you own property jointly with anyone or through any kind of trust, talk to a tax professional before you assume you are in the clear. Provincial vacant home taxes still exist in BC, Ontario, and several other provinces. They were never part of the federal UHT and have not been eliminated. This last rule might affect more seniors than any other one I have covered today. The residential property flipping rule took effect on January 1st, 2023. It states that any profit from selling a residential property you held for less than 12 months is taxed as 100% business income. It is not taxed as a capital gain. It is not eligible for the 50% inclusion rate, and it does not qualify for the principal residence exemption, even if the property was your home. Most seniors do not flip houses for profit, but many seniors accidentally fall under this rule because of life events. They inherit a property, they list it quickly, they sell within 6 months of probate, or they help an adult child by taking title to a home briefly, then transfer it back. Both situations can trigger the anti-flipping rule. Imagine Eleanor, a 74-year-old widow in Winnipeg, Manitoba. She inherited her brother's city condominium in early 2025. He had lived there for 30 years, but Eleanor herself never lived there. She listed it for sale in March 2025 and sold it in July 2025, just 4 months later. She made a $60,000 profit. She assumed the CRA would treat it as a capital gain. Instead, the CRA treated the entire $60,000 as business income. She owed approximately $20,000 in tax instead of the $7,500 she had been quietly planning for. There is a list of exemptions from the flipping rule. The death of a joint owner, like Eleanor's brother, can qualify, but you must submit the supporting documentation when you file your return. Without that documentation, the CRA will apply the rule by default and assign the full income treatment. Another trap involves gifting property to family members. If you transfer your home to your adult child while you are still alive, the CRA treats that as a disposition at fair market value. You may owe tax on the deemed gain, even though no cash actually changed hands. Seniors in Vancouver, Toronto, and other expensive cities who do this without realizing the consequence are sometimes hit with 5-figure tax bills that come as a complete shock. Here are 5 concrete steps every Canadian senior needs to do before the 2026 tax filings begin. If you live in British Columbia and you are enrolled in the Property Tax Deferment Program, contact the province before June 1st to review your options. The interest rate and compound interest rule is changing in 2026, and you need to understand the impact on your estate and on your heirs. Check every residential property you have sold since the 2020 tax year. If you did not file Form T-2091 in the year of sale, file an amendment now. The CRA Voluntary Disclosures Program can reduce penalties, but that window does not stay open forever. Sit down with a qualified tax professional before selling any second property, cottage, or rental in 2026. Do not rely on memory or advice from friends at the bridge club. The rules change every single year, and the dollars are too large to guess about. Update your will and your property titles now. Make sure your adult children, your spouse, and any joint owners are aware of how CRA rules treat inherited property and jointly held property. Even simple family transfers can trigger real tax consequences. Bookmark the official Canada.ca pages on capital gains, principal residences, the residential property flipping rule, and provincial property tax deferral programs. Read them at least once a quarter. The rules change. The CRA updates its guidance without sending you a personal letter. I want to leave you with this thought. This is money you have earned. It is money you have saved over a lifetime of work. It is money you deserve to keep. The government of Canada is not trying to steal your home, but the system is complicated. The rules shift every single budget season. The Canada Revenue Agency does not send you a friendly reminder when the rules change. They wait for you to make a mistake, and then they send a bill, complete with interest and penalties. You do not have to be a victim of that system. You just have to stay informed. You have to file the right forms. You have to ask for professional help when you need it. Hit the subscribe button right now so you never miss another update like this one. Give this video a thumbs up so more seniors across Canada can find it. And please share this with your spouse. Your neighbors, your church group, and your card club. These conversations save real money every single year. Drop a comment below telling me which province you live in and whether you have already sold a property or whether you plan to in 2026. I read every comment. We are going to fix this together. This video is for educational purposes only and does not constitute legal, tax, or financial advice. The Canada Revenue Agency updates its rules, forms, and thresholds regularly. Always verify the current rules, dollar amounts, and program eligibility on the official Canada.ca website or by speaking with a qualified tax professional licensed in your province. Dollar figures, thresholds, interest rates, and program details mentioned in this video reflect publicly available information as of early 2026 and may change at any time. Names and examples used in this video are illustrative scenarios and do not refer to any specific real individuals. Viewers should consult their own professional advisors before making any tax, property, or estate decision.